Market structure doesn't just break, it shifts first. If you can identify that shift early, everything changes. Most traders realize the move after it happens, but the real edge comes from recognizing it before it begins. This shift is what's called a change in the state of delivery, or a CISD. It's the validating signal that confirms a setup. Today, we'll dive into understanding what they are, along with how to identify them. Up to this point in the series, we've built a foundation, and now we're adding what is used to actually alert an opportunity to enter the market. A CISD is what separates the traders that react to price from the ones that anticipate it. So what is a change in the state of delivery? A CISD is an earlier sign of a trend reversing. I say earlier because they usually happen before a break of structure, which is another way to identify a trend break. For instance, here price is in a downtrend, creating lower lows and lower highs. Instead of continuing the trend by setting another lower high, it breaks the previous high. That would be a break of structure or a BOS. But not all break of structures are CISDs. So what separates a change in the state from a break of structure? The difference between the two are the closing prices. A break of structure is simply price going past a previous swing high or low instead of following the trend. But for a valid change in the state, price must close across the opening of the most recent opposing candle or series of candles between the two most recent swings. It may sound confusing at first, but you'll understand soon enough. For example, if you were bullish, you would look for a downtrend, like this one here, to be reversed. So the bullish change in the state would be the opening price of the most recent bearish candle or series of candles between the two most recent lows. To locate where the change in the state would be, identify the current lowest swing point and then the previous one. Where's the opening price of the bearish candle? It'd be located here. In an uptrend, price would need to close across the most recent bullish candle or candle's opening price between the two most recent highs. For this example, you have one high and then a new high taken, so the change in the state would be the bullish open of the series of candles. This would be the change in the state for a bearish example. Let's identify some more changes in the state. If we look from this high down to this low, the trend is obviously down, so we'd want to look for a bullish change in the state. From this high to the low, the change in the state would be this location here. As you can see, price wicked up, but failed to close above, so this would not be a valid change in the state. As it takes the low, the change in the state moves from this point down to this candle here. This low is swept, which moves the change in the state to this point. Again, price comes up, fails to close above, and then drops down again, changing the location of the change in the state of delivery to this point here until it moves further down and changes it to here. So this would be the first valid change in the state in a bullish scenario. As we trend up from this low to this high, we'll identify some bearish changes in the state. From here, this would be your first opportunity, and price fails to close below. In that case, we need this high taken to create a new one. Price moves up, takes the high. The next change in the state would be this candle here and this open. So in this moment, the high is swept and it changes in the state. Some common mistakes traders make with changes in the state of delivery are assuming every one of them are usable when this isn't the case. They must be within a fair value gap or order block, for instance, to be valid, along with going in the intended direction of the overall bias. Another mistake is that wicks aren't validation, as you saw. Price must close across the open of the candle or series of candles in order to be valid. Another one that's tough to identify is trying to find a change in the state against a trend when you're already in one. For instance, in this downtrend, the most recent change in the state location would be this point here. As you can see, price fails and later on does go to the change in the state, but some people may think this one is, although for this to be the new change in the state, the low would need to be swept. You have to be sure price has either swept a low to validate a new bullish change in the state or swept a high to make a new change in the state for bearish. You can't have a bearish change in the state if price is already trending down. The whole idea behind the concept is price reversing. If it's already in that direction, then it's not a reversal. Just like the fair value gap in order blocks, I don't use changes in the state to enter the market, rather as confirmation that a setup is present. We'll get into how I enter after the change in the state in the next phase. For now, try to get in some practice identifying them on your own. If you need help confirming whether you're identifying them correctly, I do have a link in the bio to my free Discord, The Summit, with a channel dedicated just for questions. In the next lesson, I'll be going over another concept called SMT divergence, which isn't a necessity for my model, but it can be an extra confluence. The Zenith model isn't to use all these concepts separately anyway, it's to layer them together into a complete framework, which I'll be going over in phase 3. So to wrap it up, a change in the state of delivery is the last signal you'll need to confirm an opportunity is present. Once you recognize these moves early on, you put yourself in a position to adapt instead of react. Also, if you're enjoying the series so far, be sure to subscribe so you don't miss the rest of the lessons to come, and don't forget to join the Discord, The Summit, to learn with like-minded traders. I'll see you guys in in Phase 2, Lesson 5.